Very good evening, everyone. This is Rajendran here, joining from Market Calls, and welcome everyone to Beginner's Guide to Hedging. So, this is a session for the traders or investors who are very new to hedging concepts. And we're going to learn some of the very basic hedging techniques. And in today's session, primarily, we're going to talk about what is hedging, who can hedge, why to hedge your positions, how investors can hedge, how futures traders can hedge, how option buyers can hedge, even option sellers, how they can hedge. And what are the basic advantages and disadvantages of hedging? That's a very basic thing that we've been talking. We're going to talk about that. I hope the audio and video quality is good enough to kickstart. If you simply type yes, my name is Rajendran. I'm the founder of Market Calls and co-founder of Algomojo. All right, thank you, Pawan, and thank you, Shekhar, for the quick confirmation. So, first of all, talking about hedging. Here is a standard definition over here. Hedging is more of a risk management strategy, right? So it is not a profit maximizing strategy, right? So profit maximizing strategy mostly deals with speculation. But here it is more of a hedging. Hedging is more of a risk management strategy, mostly to control the losses, to avoid uncertainty in the markets. The goal of hedging is to what? Minimizing the impact of the market fluctuation. Maybe I'll give an simple example over here. Probably a lot of the market itself surrounded by a lot of uncertainty, always. Fear of recession or the Russian war tension. Recently, the China COVID crisis, the new variant, right? BF7 variant is coming up. So every now and then the market is poised with some sort of threats in the markets. Some sort of an unexpected events happens. So 2020, the year 2020, one of the unexpected crises happened. Sometimes scams happens in the market. Like long time back, we had a Harshad Mehta scam. I think around 2018 or somewhere, 2017, 18 somewhere, we have Nirav Modi scam. Right, so a lot of unexpected events happen, and all of a sudden the Fed will keep on increasing their rates, and suddenly governments they do announce something like demonetization, or geopolitical events like Brexit happens. So the market itself totally surrounded by unexpected events. So if you want to protect, right, then hedging is one of the finest risk management strategy one can practice. There are various ways why a trader has to go on hedge. Hedging is not only for traders. It is for investors, it is for option buyers, option sellers, even intraday traders, positional traders. Hedging is for anyone, those who want to safeguard themselves. So when to hedge? When there is an uncertainty is happening. Right, so uncertainty about economical tensions, or if there is some political developments are happening, political uncertainty, sometimes, yes, they do create panic in the markets. Generally, investors go for an protections. Sometimes when people are holding very high risky investments, they are pretty much concerned about when that asset classes will collapse. Suddenly, you would have seen that some stocks would have been booming 100%, 200%, 300% all of a sudden. And then the fear kicks in when the stock is going to collapse, right? So such kind of vehicle, such kind of high risky vehicle, which is giving extraordinary returns. People fear about, they want to protect their investments. They want to continue somehow, but at the same time, they want to protect themselves. Simple example is like, after 2020, Bitcoin soared to 65,000, record high levels, unimaginable levels. And then later on, what happened? Later on, the cryptos, the Bitcoin market collapsed, right? The entire crypto market collapsed. From 65,000, they came down to 16,000 or 15,000 somewhere. A huge crashes. So such kind of high investments, if somebody is holding such kind of highly risky investments, so they might consider for hedging strategy to mitigate the potential losses if at all that the downfall is going to happen. And most importantly, many option traders, particularly they call it as hedges, even institutions and prop trading desk, they go for a passive income generation techniques. So they try to generate 1 or 2% returns in a month or so. That is a goal. Even in the previous week video itself, we talked about how institutions they trade. Right, most of them are income generation techniques. They'll be using the straddles, strangles, and then but at times they will be going for a hedging. So they try to generate an income out of it. Mostly option traders. They try to create some sort of a rental income, some sort of an 1 or 2% income, 1 or 2% returns over a period of time in a month or so. So they do use hedging a lot. Now, a lot of hedging strategies are there. Probably even in our day-to-day life also, we could have been done hedging. Nothing but insurance. Insurance is one sort of hedging, right? In insurance, what do we do? Let's say if you are owning a car or a bike, we'll be taking an insurance, right? So if at all there is any damage to that vehicle, it will be covered under insurance. So it's kind of a risk mitigation thing. Hedge funds adopt hedging strategies. Not necessarily they do involve in options, but always they carry long positions also, short positions also simultaneously in different instruments. Maybe they might be long on equities, they might be short on commodities, or they might be long on certain stocks and they might be shorting the less economic growth stocks, or even they fear that the certain stocks may not be perform well, so those stocks they go on short. Or certain stocks they consider as an overvalued, so they go on short of certain stocks. But always they maintain a balance of long and short on multiple securities or multiple trading instruments. There are times even we use physical assets, right? Sometimes we do what? We buy gold. Why we buy gold? Sometimes we buy gold, we buy real estate, because it appreciates over a period of time. Instead of we holding our money in our bank, we go and invest in gold or real estate. Maybe we consider as an investment, but it is like kind of a hedge against inflation. Some people they use, if the inflation is rising, automatically gold is going to rise. That's a old school concept which has been taught. And currency hedging, of course, any business they are having any exposure to the currency markets, they are pretty much involved in the currency hedging. Particularly big companies like Infosys, Reliance. So where Reliance is having, they are procuring oil from some other country, so they're having a direct exposure to dollars because crude oil is mostly traded in dollars. So they have to do a derivative hedging, crude oil based hedging. Something like Infosys, they are doing a lot of business in European countries and US countries, US markets. So they have exposure to both the dollar also, euro also. So if the euro fluctuates or dollar fluctuates, their revenue also fluctuates. So maybe to control that, they also big corporates mostly involved in this kind of hedging. Mostly importers, exporters, always involved in some sort of hedging. Because there are certain uncertain times, if they are not hedged properly, they may even go broke. The business can go broke. Same applies to trading also. Same applies to the investing principles also. And interest rate hedging, there are certain interest rate futures, IRF futures. I'm sure sometime back NSE introduced, but then I think because lack of liquidity, they stopped it. Interest rate futures. And in US, it is very common. In India, they introduced, but I'm not sure what is the current status. But even if the interest rates are increasing or decreasing, you can use interest rate derivatives to hedge it. So what is the primary goal of hedging, if you ask me? So markets are very volatile most of the times, right? So let me go and tell you why people hedge, or what is the primary reason one should hedge. Particularly if you're a trader, see, when you're dealing purely with derivatives, maybe you're going to adopt some strategies, let's say some super trend strategy or some pattern detection strategy. If you keep on trading your strategies, what will happen is like you'll be making money, you'll be losing money, making money and losing money. So there is a volatility in your portfolio. Like your money, let's say your money is keep on growing over a period of time. It will not grow in a straight line, right? It goes up and down and it creates a lot of volatility in your portfolio. Now, what does these hedging will do is it will reduce the uncertainty. Maybe if the price is going up, it will not be going up too heavy. When it's going down also, it will not be going down very heavy. So it reduces the fluctuation in your portfolio, in your returns. When it's going up also, it will be trying to go up. Again, when it goes down, it will not go down too much. When it goes up also, it will not be going too much. So it reduces the uncertainty and it will give you slow and steady returns. Of course, it is definitely not going to maximize the profitability. But if at all there is a huge uncertainty is there in your portfolio, let's say for some reason you're having a huge risky asset, all of a sudden you are facing a strong downside, if in case without hedging. So what hedging will do is like the hedging will save you from the uncertainty. So maybe your hedging will save you from such kind of uncertainty. Let's say suddenly there was some big gap down, some 10% gap down happened, or something bad happened in the world, some bad event got striked. Hedging also incur losses, but it is not that deeper losses, but it will be able to manage to go on. Whereas here in this case, it becomes totally bankrupt. The strategy without hedging goes bankrupt. Whereas here, the strategy with the hedging, it survives. It survives and keeps making money. So that's the primary importance of hedging. Without hedge, what will happen? When there is an uncertainty, just like that, a market will not crash. There will be always underlying theme behind that. You take every crash in the markets, there will be always some backstories behind that, right? Maybe I'll pull up the Nifty chart and then we'll talk about that. So let me go back to tradingview.com. I don't want to get into too theoretical things. That's why I'll try to make it as much as practical as possible. Let's say we'll go to Nifty here. It's a simple line chart only, nothing much. So if you see this place, there was a crash happened over here, this crash. You know the reason behind the crash over here? This is back in 2018. Every crash, it's good to know why the crash happened. Always there'll be some backstories will be there. Just like that, without having any backstories, just like that, the market will not collapse at all. So this is a place, two things happened over here. I think 2 or 3 things, I think probably we had experienced long-term capital gain, LTCG, government announced, right? It's uncertainty, what everybody was anticipating, and then the anticipated thing happening, right? It's a long-term capital gain, long-term capital gain. And then what happened in the market is like all of a sudden there was a risk of, Nirav Modi scam. Some 20,000 plus crores of scam. I think it happened. Like so, it's a big scam though. I'm not sure about the numbers, but numbers are really big numbers. And then at the same time, US market also collapsing because there was an US-China trade war tension. US-China trade war tensions. Trade war tensions. Government policies are bringing in, this has happened during the budget only, and then scam is happening, and all of a sudden some geopolitical tension between US and China, like the economic trade war tensions are happening. That is one of the reasons which is attributed to this crisis. And at the same time, if you could see that from an investor point, this one also, there are two things happened over here. Again, ILFS scam happened over here. IL and FS scam. ILFS crisis, we should say. It's not a scam though, but ILFS crisis. And then we also again experienced the same US-China trade war tensions. Back and forth, US and China was keep on putting pressure on each other economically. Trade war tensions. Then this is the one which is the most important one. This mega down move is what is attributed to COVID crisis. China COVID crisis. We faced a complete economic shutdown. And this is the phase we faced a total economic shutdown over here. Economic shutdown, and the entire nation goes for a lockdown. Almost not only India, most of the countries in the world, they went for an economic lockdown. And then we have a sharp recovery because Fed printed a lot of money. And now recently we went through a phase of again a crisis period. So this crisis period here, not every down move is attributed to a selling, but whereas so we had that attention which started over here. So attention which started in the form of Russia-Ukraine tension. Ukraine war tension. I'm not sure, but still the recent down move is attributed to the Chinese COVID BF variant. So these are the economic reasons. Always some reason will be always attributed there. Even if you go back sometime back before that also, always there will be always some sort of an down move. Each and every downside move, it will be attributed to some sort of crisis. So back in 2016, we had seen a bear market. It's a bear market which started from March 2015. It almost lasted very close to a year. This entire down move is also attributed to banking NPA crisis. It's a very slow and steady sideways correction, right? A reasonable correction happened in the markets. It happened for a reason. The reason is pretty simple: NPA crisis, NPA banking crisis. That's what it happened over here. And then the biggest crisis happened in the back was like 2008 subprime crisis. So this correction is primarily because of subprime crisis. So why I'm saying here is like just like that, a market will not correct 40%, 50%, or 100%. Just like that, a market will not correct. Right? Always there will be an underlying fundamental reason will be behind that. Subprime crisis. Almost from 6,300 levels, we went to 2,500, 2,250 kind of level, I think. Okay, so coming back to the topic. So there are various ways one can hedge, but specifically in this chapter, we're going to talk about how a trader can hedge, how an investor can hedge, how an option buyer can hedge, and how an option seller can hedge. That is what we're going to look into the today's topic. So who can hedge? If you ask me, investors can hedge, right? So because at times they will be having a huge portfolio of investments. Maybe some even an investor who is having a portfolio like 50 lakh, 1 crore, and a portfolio. all of a sudden they fear that if the market is crashing, so they need some sort of protection, right? They need some sort of insurance. So that's what the options are for. Options and futures are primarily designed for that only. The traders, of course, there are many day traders, professional traders, institutional traders. They can also hedge their strategies to manage their risk. Because I can design a strategy in options. I can design in such a way like if I'm running the strategy, if market is moving in my favor, it's totally fine. If the market is moving against my favor, I don't want to lose not more than 1% of my portfolio. So like that, as a trader, I can design my strategy so that one can control their losses. One cannot totally avoid the losses, but one can control the amount of losses. Rather than if the price is tomorrow, Nifty is opening gap down by 5%. If somebody is not hedged, what will happen to their position? They might be losing, right? They might be losing 10% of their money or 20% of their capital. All of a sudden, if tomorrow Nifty opens gap down. But if it is well hedged portfolio, if your strategy itself is very well hedged, then of course, traders also take benefit out of that risky. I mean, they can eliminate that risky business. Business does hedging, right? Very often, because for many business, commodities are the raw materials. In some cases, for business, currency is a threat if they are doing business with other countries. Government does hedging, right? Government does hedging. Banks does hedging. So there is only one major difference between hedging and speculation. The hedging, the primary goal is to minimize the impact of the market fluctuation. So that is what I showed you, that if your portfolio is hedging, or if your stock is very volatile, by hedging, one can do what? One can reduce the volatility in the portfolio. Means if the proper procedure is followed. Whereas in the speculation, it is more of taking a directional bets in the markets, trying to profit from the price action, mostly. And hedging is primarily focused on minimizing and protecting against potential losses. Speculation is focused on maximizing the profits. That's the difference. Minimizing the losses here in hedging, whereas speculation is maximizing the profits. We have futures, call option, put option for hedging. If you are an investor, let's think about a simple example here. Let's say if an investor is holding 1,000 shares of Reliance, bought at 2,000 rupees average, he might concern about a potential recession. Maybe he might think that last 8 years there are no recession. Now Facebook is firing off, and maybe the parent company Meta fired off recently, and there is a massive layoff happened in Amazon. Across majority of even in Indian companies like Baidu is firing off in masses. Right? Many companies like many big companies are considering firing the people. So there could be a possible recession could be there. So maybe in that case, the investors might be little concerned about the macro event which is happening in the markets. Not so good thing, it's mostly shaky. So maybe at that time, for time being, they might consider for an hedging. If you ask me, should I always have to hedge as an investor? Let's say I'm already holding a 50 lakh portfolio or a 1 crore portfolio. Should I always have to hedge it? If you ask me, absolutely no. That's a dumbest idea, because hedging is always a cost. You're paying for that. Every time you are buying an hedge, you're paying for that. You're paying for, at least we are paying a transaction fee, and we are paying an time premium if it is an option buying. So only when there is an uncertainty, or when you're anticipating an economic uncertainty, or maybe your technical patterns are showing weakness, but still you want to hold the asset classes, still you want to run your strategy, still you want to hold your view is right, but still on a safer side, you want to get some sort of protection. Only in that case, investors should go for a hedging. So the question is again the same thing. Should an investor remain in the hedge all the time? Definitely, it is not advisable. Because in the long run, it will be keep on adding to the cost over a period of time. Because you have to purchase option contracts every now and then. So for an investor, what could be the reasonable hedge? What do you think? When an investor should hedge? By looking into the candlestick charts. Let's say I'm just looking into the monthly charts. Let me go to a monthly chart. So this is monthly chart of Nifty futures. I'll go to monthly chart. Markets are in a cycle, right? Always. When you can hedge? What is the right time to hedge? Probably. By looking into the current scenario, will you hedge or not? What do you think? You can just type it out. Yes or no, maybe. Looking into the current scenario, you are looking into the monthly charts. Will you hedge or not? If you're hedging, what is the reason behind that? Definitely some sort of shaky things are happening, right? So globally also some sort of shaky things are happening, and price action is also more or less broken the previous month low. Or some investors, they might consider hedging if they are going for a quarterly breakdown. If at all, quarterly so far it's not broken down yet, but maybe some investors might be consider hedging if the previous quarter low. So currently the quarter low has been what? 16,858, right? Maybe most likely probably I think somewhere around an October month is what it happened. So as long as that 16,858 is not broken, maybe some investors may not hedge at all. Maybe they think like, okay, the trend is safer. Maybe some people, what they'll do, they look into some sort of an Aikanashi kind of techniques. So let's say I'll go and pick up something like Aikanashi. Okay. So I'll apply this on a monthly scale. The Aikanashi thing is like kind of in a bull market, it'll be keep on maintaining green. Or maybe as long as it is maintaining green, then there's no point of hedging for them. So they use simple techniques for hedging, right? So until that case, for example, if they would have been considered hedging, if the Aikanashi is turning negative, every time the Aikanashi is turning negative, they might consider hedging for time being. Because maybe they could have been lost over here because nothing happened. They could have been lost over here. They could have been lost some money over here. But they could have been safer. They would have been saved all their money in that bigger crisis. When that big crisis happened, they would have been saved a hell of a lot of money over there. So as I said, hedging is totally a cost, right? Or you can also apply some simple techniques. The simple techniques is what generally one have to go at an investor level. At an investor level, they should not think too much. Trying into daily chart and then hedging, I don't think it is not a better idea. Maybe if the size, it depends upon the size of the portfolio and how much risk they are willing to take and how much protection they want. Again, that depends upon various factors. Just like that, one rule will not going to satisfy every other investors, right? But if somebody is concerned about economic uncertainty, or if they are considering that something suddenly a huge, sometime back, the Adani, right? So most of the Adani stocks skyrocketed. So generally people have that doubt, will it crash or not, right? That is a kind of context which has been going on. So last couple of days, Adani has been crashing down. So yes, in that case, if there is an uncertainty is also there, some global uncertainty is also there, then in that cases, considering hedging is worthwhile doing that, right? Otherwise, blindly hedging, definitely it's not a recommended one. So this is from an investor perspective. Maybe they can use simple price action. That is the ideal thing that I'm trying to explain over here. Ideal, it should be price action combined with some sort of economic uncertainty. Whereas if you are a trader out there, let's say I'm a trader who is holding long futures. I'm carrying my futures. I don't want to carry my futures naked all the time. particularly during weekends, because weekends is where most of the crisis happens. When Monday market starts, there could be some sort of uncertainty always kicks in sometimes. Sometimes there could be an, I think sometime back there was a Saudi bomb attack happened on the weekend, and oil prices like skyrocketed. It opened with a 20% upper circuit. And there are most of the missile tensions will be happening mostly on the weekends. So if you are even if you're a future holder, one can hedge using an options. If you are a long future holder, you can hedge it with a long put option. If you are shorting the futures, still you can hedge your position by taking a long call option. So what is the benefit? I'll tell you. Let's say if I am holding, if I'm simply buying a future, right? For that, I have to go to a broker, margin calculator. So I go to margin calculator over here. Let's say if I'm a futures trader, if it's a pure intraday, if I'm maintaining a stop loss, it is good enough, well and good. I don't need to do any hedging. If I'm having a predefined entry, exit, then there is no point of hedging. But overnight, at times, there'll be a big gap up, big gap down. Very much we witness, particularly during the events, when event is happening, like Fed announcement is happening. At times, there is a big gap up or a big gap down can happen. Or let's say some election poll is happening and the election poll is turning big positive. There could be a big gap up or again a big gap down. Last time, I think 2019 election, exit poll was happening, and that particular day, Nifty was up by like 4.5%, roughly around that level. It also happens with a huge gap up also. And even recently, US inflation numbers started cooling down for the very first time, reasonably. And then all the global markets opened gap up, including US markets. And from there it crashed, that is secondary. Later on it crashed, but that point, it's suddenly giving a positive boost. So whoever shorting the market, they would have been incurred terrible losses. So let's say in case of Nifty, if I'm trading in futures, say if it is Nifty, let me pull up the current contract itself, December contract, I'll add to that. So if I am buying Nifty future, I have to pay a total margin of roughly around 1,05,000 rupees. Now, it could vary, right? Depends upon the pricing, it could vary, but at the current situation, 1,05,000 rupees is what the margin I have to pay. What is the margin? Margin is like a kind of a security deposit. I have to keep it with the exchange. The exchange will collect upfront margin. But if I am also going to take a hedge, right? What will happen is like, I'll tell you what will happen. Maybe I'll show you simultaneously with an option strategy builder also. So this is a margin which is required, 1,05,000 rupees margin for buying one lot of Nifty futures. Here also I'm going to construct the same thing over here using Opstra. I'll go to Nifty futures. I'm going to buy it. I'll add to the position. So I'll be getting a payoff graph. My payoff graph, if you see that, let me do one thing. I'll add to the position. In my payoff graph, if you could see, profit also unlimited, losses also unlimited. Since losses are unlimited, exchange charges a huge margin over here, 1,05,000 rupees per contract, per lot. But if I am controlling the risk by adding a hedge, let's say I'll show you the hedge. I'm going to add a hedge over here. I'll add a put option over here. So I'll go to options, same strike, same expiry, 18,000, maybe instead of 18,000, I'll go and take like 17,800 put option. Put option, I'm going to buy it. I select buy and then I'll add to the position. You can see that the payoff graph, the losses are now get controlled. The orange one is the losses one, it's getting controlled. So now my losses are very much controlled to 8,395, but my profits are unlimited. Right. So within that view, if this satisfied somebody else's requirement, then they can consider hedging. Right. So instead of keeping a stop loss, they can take a hedge and then they can trade it accordingly. But as I said, hedge is more of a cost. Here, time is an erosion for an option buyer. So option buying is the hedging over here. So as the time flies, sometimes the option erodes. Unnecessarily, we'll be wasting money if price is still moving in our favor. So, but there is a decent advantage over there. The advantage here is like, I'll go to the options, I'll go and pick up the same option over here. It's a put option, right? Put option, 17,800 put option. If I add to that, what will happen? I'll tell you. What will happen is like exchange will collect only lesser margin only. And they will give a margin benefit to that, kind of a margin waiver. They will not collect huge money as a security deposit. Instead, they will collect only 684 rupees only. So why exchange is doing that? Because earlier your strategy is highly risky strategy, unlimited profits, unlimited losses. But now what is happening? By taking a hedge, put option as a hedge, your losses are getting controlled over here. Since your losses are controlled to 8,000, no matter what, tomorrow, even if the market is opening big gap down, 20% down also, you will not lose not more than 8,395 rupees. So since your losses are controlled and it is not going to exceed not more than 8,395, exchange also collects lesser margin only. So within that 2,360, 684, if there is a sudden uncertainty is there, exchange can settle the losses. On behalf of you, exchange will settle the losses and they will pay you the remaining margin back to you once you square off the positions. Right. So that way, exchange provides that too. Earlier, we don't have this kind of margin rules. Post 2020, I think from June onwards, they implemented this new margin regulation rules where exchange started offering a lot of margin benefits for the low risk strategies. So without an put option, futures are considered as highly risky. I mean, without an option as a hedge, futures are considered as a highly risky trading instrument. But with put option over here, it becomes low risk strategy. Low risk, high reward kind of strategy it is. So this is one important information that you need to know over here. Even if you're an option seller, let's say I'm an option seller, I'll reset my position, I'll go and sell an option. I'm just bearish in the markets. So if I am bearish, what I have to sell? If an option seller, should I have to sell call option or a put option? I'll go to option, I'm an option seller. So I'm going to sell an option in Nifty. If I'm bearish in the markets, I'm bearish about market activity. In that case, I'll be selling calls, right? I'll be mostly selling calls. If I sell a call, selling a call also involves what? Highly risky strategy, right? So let's say 17,800 call option is what I'm going to sell at the money call option. I have to pay a huge margin over here. Maybe same thing, I also bring it over here as well. Call option, 17,800 call option, I'm going to sell it. Of course, Opstra also provides a clear-cut margin estimation, right? But it's good to rely on the broker side. Along with that, if I want to hedge, for an option seller, a hedging is always an option buying again. Even for futures also, option buying is a hedge. Option seller also, option buying is a hedge. So I will buy mostly cheaper options. So 163 rupees premium I paid over here. So I'm going to get some cheaper option as a protection. So I'll go and buy out of the money option, something like 1,800 call option I will buy. Cheaper option, maybe 40 rupees is the option premium right now. I will buy it. So 1,800, I will go and buy it over here. Now what will happen? Earlier, if you look into the, without this, maybe I'll remove this. 1,800 CE, I'll remove it. If you see that the strategy is having limited profit, unlimited risk. Tomorrow, if there is a huge gap down, the traders could lose a lot of money there. But if I add a hedge along with that, the unlimited side, which is like a price moving with a huge upside move, if suddenly markets are turning hugely bullish, the option seller could lose a lot of money there. Instead, if they add a call option position, cheaper call option position with a cheaper premium, What will offer is like the losses will get controlled. Earlier losses are not controlled. Now this is what we call as a spread, right? So we'll be having an at the money put option or in the money put option or in the money call option, and we hedge it with an out of the money call option. So it's called a spread, like call spread. So likewise, if they are having a directional opinion, still they can go and hedge it. So let's say I'll go and hedge it with an 1800 call option. I'm going to buy 1800 call option. 1800 call option. Along with that, I'm going to buy 1800 call option. I have to buy it. If I add that, what will happen? Again, exchange will provide me margin benefit. Why they are giving margin benefit? The reason is very simple. Because earlier your strategy is not risk controlled. So exchange used to charge a huge margin. Now your strategy is more or less limited profit, limited losses. Losses are limited to how much? Again, 8,800 rupees only. So exchange is collecting a fair margin for that to avoid any uncertainty, to settle down the losses. So that is what they call as an upfront margin. They collect upfront margin to that. So how exchange knows, how the broker knows how much margin they have to collect? Automatically it calculated based on your current open positions, right? So if you are buying option and then you are buying a future, immediately you'll be seeing that the position, you will be immediately seeing that the margin is returned back to your account the very same day. Instantly will be returned back. You buy the futures, 1,05,000 will be locked in your account. Immediately buy a put option, that margin will be released. Some part of your margin will be automatically released in the form of margin benefit. So this is with an option seller stuff, right? So an option seller can hedge it by simply buying a out of the money call option of the same strike or nearest strike. Now, some trader, what they will do, they will buy long dated options. For example, that is what it's called as a diagonal spreads. Let's say I'll go to, I go to the strategy builder. I'll reset over here. Let's say I am bullish in the market. So if I'm bullish in the market, I have to, as an option seller, I have to sell the put option. I sell the put option. So I'll be bullish for next 1 month. So I'll go and sell January month contract. Let's say 17,800 is what I'm going to sell. Premium is huge, 250 rupees premium. I'm going to sell it. So I'm an option seller. I'm selling it. I'm expecting markets to go on the upside. So I'm bullish. But at the same time, I want to hedge it. But I'm just thinking that there could be an uncertainty for the next 3 days or 4 days. So I thought of hedge my positions. Rather hedging in the same expiry, what I'll do, I'll go for a cheaper expiry. So cheaper options will be available under nearest expiry. So I'll go and get to the recent weekly option or a monthly option. And then I'll hedge it with something like a very cheaper option. So something like 1,800, 17,500 put option. It's like 33 rupees. I just simply buy it. So hedging not necessarily from the same contract. It can be from a different contract also. So this is also a kind of a spread, right? So this is called as a kind of a diagonal spread or something like that. So hedging can be done in the same expiry. It can be done between different expiries also. If I'm an option buyer, how I can hedge it? Anybody? If I'm an option buyer, how I can hedge it? Which is very simple only. If you're an option buyer, option selling is the hedge for you. For an option seller, option buying is a hedge. For an option seller, option seller, option buying is a hedge. For an option buyer, option selling is a hedge. Let's see how it is a hedge. I will see that. Let's say if you are bullish in the markets, I'll be purchasing something 17,800 call option. I have to pay a premium of 163 rupees. So 163 rupees I'm paying. Here, for me, a cheaper option is a hedge again. Buying also cheaper hedge is an option. Selling also cheaper hedge is always an hedge for the option buyer. For an option seller, cheaper option buying is a hedge. For an option seller, for an option buyer, cheaper option hedging, selling is a hedge. For example, again, I'll go and sell 18,100 call option. 17,800, I'm gonna buy it. So my portfolio will be looking like this. So I want to minimize my losses. The goal is what in hedging? Minimize the losses. So if I want to minimize the losses, what I'll do, I have to go and get something like 1800 call option. I will sell it. Since selling involves a little bit of a risk, they will charge, exchange will charge margin. As of now, for option buying, they charge only premium money only. You will not pay any margin. But now by selling options, since selling option involves risk, so they will charge additional margin to that. Right. So anyways, earlier also risk is there, but now the risk is getting controlled because you're adding a hedge to that. At the same time, hedge also reduces the profitability also over here. Earlier, the strategy was having unlimited profit on the if you are buying a naked call option. But after hedging, you are capping your profits. Post 1800 plus, post that it will be totally capped. After the 1800 plus, your profits will be totally capped. So means even if market goes beyond that, you'll not be able to enjoy that profit. So that is how the option buyer will hedge. Even if you're an option seller, let's say you are trading a triangle or a straddle, you want to hedge, you can go and hedge on both the sides. Because neutral directional traders, right, most likely they'll be expecting a sideways market. Mostly short volatility traders. We call them as a short volatility traders. Their main position will be always a straddle or a triangle. Sometimes they will hedge it on only one side. Sometimes they'll hedge it on both the sides. Sometimes they'll maintain unequal side of hedges. So one side they will hedge like 200 points, another side they'll hedge 400 points away from that level, like kind of a broken wing butterfly or something like that. So iron fly or iron counter kind of strategies are kind of neutrally hedged strategies. Already the nature of the strategy itself hedged strategies. In fact, many institutions, even in India, they run a lot of iron counters to generate some 0.5% returns or 0.25% returns in an entire week. I'm talking about. Maybe in an entire month, they try to generate somewhere between 1 to 2% returns. Mostly iron counters is what majority of the traders, iron counters and butterflies, they prefer to do, but they do it with a large size. Right? So hence for them, hedging is the primary thing. For institutions, hedging is always a primary thing. Because tomorrow the business has to go on. Just like that, they cannot lose 20% of the money overnight just because market fallen because of something happened in China or something happened in Argentina. We cannot lose our business, right? Just because some event happened. So they always remains in a hedged manner because for them, business has to move on. No matter what is happening in the economy, whether it is good or bad, the business has to move on. Again, we also seen that option buyers, cheaper hedge is what? Option selling is the hedge for the option buyers. So by now we might have a fair idea what are the major advantages of hedging. So here I listed out some of the points. The primary aim is to manage the risk. Not only that, protects against potential loss. Suddenly, if there is any uncertainty, huge uncertainty is there, I want an protection. For that, people go for a hedge. It manages the risk. That's why people go for hedging. It will, for an investor perspective, it will help investors to reduce their overall risk of their investment portfolio. And it also preserves the capital also, of course. So what are the disadvantages if you ask me? Cost. Hedging is always a cost. The moment you start talking about hedging, your profitability is likely going to get impacted. That is why you cannot be keep on remaining a hedge. I mean, I'm talking about from an investor angle, right? So if you're a trader, it's up to you how you want to maintain. Sometimes you can maintain a naked position, but if you're seeing a threat, you can consider low risky strategies by hedging, by adopting some hedging techniques or hedging strategies. And definitely there is a fees involved whenever you are doing you're buying a hedge or you are selling an option. There's always additional fees are involved over there. If it's an option buying position, time premium erosion is there. So missed opportunity. Sometimes what hedging will do, you will try to hedge, but market moves in your favor. Because of that, your profitability would have been declined. It will limit the potential of profits. And the hedging offers only limited protection only. It offers a great protection, but it doesn't mean like you will not be totally risk-free. Tomorrow, if the price if there is a suddenly 20% collapse in the markets, it doesn't mean like you will not lose not even a single penny. You will lose money, but the amount of loss will be very much controlled losses. That's what the ultimate aim of the hedging. I hope in this video tutorial you would have gained some very basic insights about hedging. So we almost discussed about from all the perspective, from investor perspective, from an option trader perspective, option buyer perspective, option seller perspective, even from a future trader perspective, how it impacts the margin, right? How the margin gets impacted if you hedge it, how a low risky strategy will give margin benefits, when to hedge, should I have to hedge all the time? So those are the things we spoken about it. If you gain very basic insights about hedging, definitely you can send your comments in the feedback section. Always you can go to webinars portal. So here you can give your feedbacks and comments. So always you can go to the webinar section. From there you can get to beginner's guide to hedging. At the end, you can go and give your comments. You can go and give your reviews over here. You can rate the reviews. If you really learn something really interesting, or maybe not enough learning, you need more learnings. So let me know about everything in the comments so that it helps us to improve. Next time when you're attending the sessions, we'll try to keep something very much engaging contents. So let me say thank you for coming by, and thank you for spending your wonderful time with us. Thank you.